Good evening. Welcome to Chasing the Facts. I'm Sam Chase, your host, and with us tonight is Chelmsford's Chief Assessor, Frank Reen.
Thank you, Sam.
I'm glad you're here.
Glad to be here. Glad you're having me.
Well, the timing is very apropos because, as we all know, the fiscal year 2020 property tax bills, the official tax bill went out.
The actual tax bill.
The actual tax bill. We'll talk a little bit about that, what's an actual tax bill, what's an estimated tax bill, and so forth. But before we get into that, I ask every guest that we have just to give us a little bit of a bio sketch, your background, what you bring to the job, and that kind of thing. So if you could just do that, that would be great.
I started out as a carpenter back when I was in my early to mid-20s. I did that for about 8 or 10 years. And then that kind of work was kind of drying up. So I've always had an interest in real estate, so I looked at appraising, fee appraising they call it. So I did that for about a year. And then my father saw an ad in the paper for somebody with appraisal and construction background for the town of Reading to be the assistant assessor, whose responsibilities were to go out and measure homes and that sort of thing. So I applied for that position, was fortunate enough to get it. And I did that for about 6 years. I took a lateral position here at the town of Chelmsford. I was living here at the time, so it seemed to make sense. Got that position, held that position for about 2 years when my predecessor retired, Diane Phillips, a terrific mentor. And I was fortunate enough to get that position as the chief assessor, and I've held that position since roughly October of 2000, I think it was, to present.
Well, that's a very good short encapsulation of your background, and I think it's particularly relevant that you've had actual hands-on experience in the trade, carpentry trade, and building and construction and so forth, because that's certainly part of what you do. It calculates into how you do your job, actually, so I think that's very interesting. One thing that was interesting, I remember when you were hired, back in the early 2000s, I think it was. You also, for quite a while, were actually, in addition to being chief assessor, you were on the board of assessors.
That's correct. I was on the board of assessors as well as being the chief assessor, which is not an uncommon occurrence. Bill Ricker, the assessor there, is on the board, has been on it for many years. It's fairly common. It has its advantages in that for certain signings that need attention right away, at least one of the assessors is right there. So I held that position for some time. After a while, when it became available that we could get other people appointed, it seemed to make more sense than maybe having myself as just the chief assessor and then a 3-member appointed board serving in that capacity would probably be best.
And I know that Paul Cohen, when he came in as town manager, felt very strongly about that.
As did I.
There should be that separation. I think the comparison is it's roughly analogous to a chief executive officer of a corporation sitting on the board of directors or even being a chairman of a board of directors, and that situation is not uncommon. I disagree with that. I think there should be the separation, and I think it's good that we do have the positions separated like that.
I think so too. What would happen is I would be presenting something to the Board of Assessors, in which I would then put it on another hat and vote on it. That could be awkward at times.
Validating your own recommendation.
That's right. What's the likelihood I'm going to present something and then vote it down?
Exactly, exactly. So, well, that's very interesting. I think the position, and certainly you've held it now for what, about 16, 17 years?
Exactly right.
Yeah. So you've built up a very good background and knowledge of the real property situation in Chelmsford. That certainly serves the town well. I'd like to take some time and just talk a little bit about the science of appraisal as it relates to the assessor's job. And what we have and what most people understand is the value of their real estate. They might call a real estate broker and say, you know, we're thinking about putting the house on the market. Can you come over and give us an idea of what the value of the property is? And they'll do that, and they'll conduct, you know, kind of a survey to see what the deal is. So how is that different from how the assessor goes about valuing, say, residential property?
Sure. You're right that very often a broker is called in to do kind of a market analysis of somebody's home, and that's sort of the high 30,000-foot elevation, quick analysis without any real deep analysis. With the distinction really between, say, fee appraising, which is what I did just prior to becoming the assessor in Reading, and what I do now, a fee appraiser will go out and look at and identify the subject property, a property, and come up with 3 to 5 comparable sales that occurred ideally within a short distance from the subject and within maybe 6 months of the appraisal date. And then take those 3 to 5 comparables and continually adjust them to the subject property, trying to get very specific details about them and establish what the value is for that subject property. Mass appraisal, which is what assessments really are, is sort of almost the opposite. The terminology is very much the same, but it's taking maybe 300 sales, conducting an analysis on those 300 sales, and establishing what that market is and applying it to the rest of the inventory, the rest of the town. With some other parameters. We already have excellent data on all our properties, so it's a matter of updating the cost tables, the land tables, and some of the other specifics. So the terminology between fee appraising and mass appraisal it can be very similar. When an appraiser comes in and we talk, we're speaking to some extent the same language. It's just sort of the inverse in a way. That's with the residential side. That applies to both the condominiums as well as single families and some of the 2 and 3 families that we have in town. When you get into the commercial stuff, there's some relationship between how it's done in the private sector as well. It's still primarily income approach, but certainly the cost approach and the sales approach play a role in that.
Mm-hmm. And I think you've described the differences and the distinctions very well between the two types of appraisals. And that leads me into a couple of other things. Now, I probably should have said this at the beginning. Full disclosure for people who are watching the show and don't know, I happen to be on the Board of Assessors, and I've been on the board since 2008. So I've worked with Frank for many, many years and developed a very good appreciation for his skill level and professionalism and expertise. And of course, you get a lot of questions. I get a lot of questions relative to people's property values and how the process works and so forth. And there are 3 things that I get hit with constantly when I talk assessments to people. And I call these misconceptions, and I think it fuels a lot of misunderstanding. So I'd like to deal with that just for a little bit. The first one I get constantly, and I've seen it on I've seen it on Facebook postings and had conversations with people. People seem to be of the opinion that the way the assessor determines the value for their particular real estate, their residential property, is the assessor looks at sales. And that's all the assessor does. The assessor looks at sales and maybe, picks properties that are comparable in terms of style of home and size of lot, and then kind of takes averages, and that's how they determine it. A lot of people think that's the way it's done. That's the first thing. The second thing that I get a lot of is, well, if you see a property advertised in the paper, that's its value. And the assessor probably should be looking at real estate ads in the paper and updating his file. And Frank is laughing at me now because we actually had a situation a couple of years ago where both Frank and I dealt with a resident who was firmly of the opinion that that's how it ought to be done. And the third thing I get, and probably this is the most common thing I hear, if a 1-acre house lot is worth $200,000, then a 2-acre house lot is worth $400,000.
Well, if that were true.
So yeah, well, I think a lot of people would wish that were true. And those are 3 areas that I hear constantly that really just, those conceptions are not accurate. So if you could just kind of touch on those.
Certainly you're right with respect to the first point you bring up, that sales only determine the valuation. When I take the 300 sales, and first we get the sales and we vet them and make sure that they are arm's length sales, a willing buyer, willing seller with separate interests. So we've cleaned up those sales, again, what we call qualifying those sales. And we do an analysis on those sales. But what we also do is take a look at our cost tables, and we look at industry standard cost tables, Marshall and Swift being the primary.
And this would be for the improvements on the property,
That's
the
correct.
buildings.
The building itself, the improvements. So what we're trying to establish with that is the replacement cost new. Replacement cost new, if you had to, any one of these homes had to be replaced today with current building materials, current labor, what would that cost be? So we use the Marshall and Swift, and then if anybody's used Marshall and Swift for insurance purposes, knows there are a number of different factors that are, then follow it. Location within the state, quality of the construction, all of which continually adjust that price per square foot. So we reconcile that number with the sales ultimately and make sure there's a relatively tight relationship between the two. Great weight is given to the sales analysis.
Of course, and I think.
But the cost approach certainly,
Right.
and as you continually state, it's the two approaches that have to be at least reviewed. Ultimately, one is given greater weight in that. In most cases, certainly with residential, it's the sales.
Correct. I think it might be fair to say that the sales, when you look at sales, what you're really trying to do initially is to determine the market.
Yes.
That's what you're doing. And then for the specific property in question in terms of the, and of course you have to do that to get land values by extraction.
That's right.
But to determine the value of the building, it's really what it costs to build the building new, less whatever the depreciation
Exactly
factor
right.
is, or any other obsolescence
That's correct.
things that might be built into that. So it really is the sales and the cost methods that are taken together that determine the value of your property. So that's okay. That's good. So we've dealt with that. What about real estate sales listings representing actual value? What do you have to
The issue
say
with
about
that, assessments are, and often brokers and appraisers have to take issue with this, and certainly residents, when they look at the present value on markets, if you will, to compare them to the assessed value. For instance, the fiscal 20 valuations that we have out there now that were just issued, that's based on calendar 18 sales. Like any appraisal, an assessment is a picture in time. January 1st, 2019 is the assessment date, using the prior 12-month sales, which would be calendar 18. Well, from a real estate standpoint, I'm certainly a broker and an appraiser, calendar 18 is ancient history in many respects. But to me, that's the relevant year that I would look at to determine these sales. So that's why sometimes there's a bit of a disconnect between present value on listings on market and then comparing to my assessments, which are based largely, almost exclusively, on the calendar 18 sales. So while it's something to look at, and if that's what they present to me, I'll certainly review that, but I caution them that that's not the calendar year that I would be looking at.
Right. It's also not a sale.
And it's an on-market, it's not a sale.
You look at
frequently, I
sales.
get that, and that's what we were referencing
Right.
earlier, that they would bring in a home with a fantastic listing price. That clearly somebody, frankly, is just taking a shot, and if they get their number, they get their number, which, I understand.
Good for
that.
them. Exactly. Exactly.
So I fully understand. Now to your point about the 2-acre. Land and building is done, it's all an economy of scale. Like you say, a single-family lot might be assessed for $250,000 to $300,000.
The land itself.
That's correct. And then multiples of that are valued, in this case, Chelmsford, the first acre is valued at, say, $250,000. Every acre after that is valued at $12,000 per acre. What that establishes is a curve. So as you increase the square footage of a lot, the price per square foot, it has the effect of driving the price per square foot down.
Right.
It creates a curve. That's also true with building value. As you get into larger colonial homes, 4 and 5 and 6,000 square feet, frequently you'll have a relatively smaller price per square foot. The value ultimately is higher, of course, than, say, the 1,200 square foot colonial. But on a per square foot basis, it actually begins to drop down once again, established. Because if we didn't, we would have those large colonials absolutely with enormous values, exceeding market.
And I think I've probably gotten more calls from residents on that particular issue because what they do is they look at their property and they see what the land value is, and then they look at somebody's property, an acquaintance that has a very similar house and so forth, and maybe that person's building lot is twice the size, and the question is, well, either I'm being assessed way too much for my 1 acre, or
Right.
he's not being assessed enough. So you've just explained how it works. And the other way to look at it, I think, is the assessing, when we establish those values, we're looking more at the use of the land versus the size of the land. So if you have a building lot that's 1 acre, you're only going to put 1 house on it.
That's correct.
Okay? If you have a building lot that's 2 acres, you're only going to put 1 house on it. So the usage of the land is for a house lot. And so if you follow that logic, it doesn't follow that the land itself would be worth twice because it's the same use.
It supports a home.
Does that make sense?
It does. It supports
Okay.
a home. The other thing to remember about land, and frequently I get these questions when somebody has another piece of land, it's valued quite a bit less. We value, of course, a vacant acre deemed buildable, full and fair cash value. If there's some cloudiness surrounding whether they would need to get relief from the Board of Appeals is to get a permit to build, that it's potentially buildable, pending that decision by the Board of Appeals, we would consider it 50% of full and cash value, where there's quite a bit of some uncertainty surrounding the viability of building on that. If definitively that lot can't be built on, without regard for the size of it, frankly, it would be roughly 10% of full and fair cash value. And it shows and demonstrates that there's some value to that land, but certainly not not full and fair cash value.
Right. Well, I think
full value.
Yeah, I think you've given a very good explanation for those three areas, and hopefully people will take note of that. So we all know that the tax bills just went out.
They've been successfully mailed at us.
And let's talk a little bit about the tax bills that just went out and some of the questions that people might have. The first thing that I think we need to say before we start the discussion is that the taxpayer should know that the town operates on a government fiscal year basis. So in other words, the fiscal year that we're talking about starts on July 1st and runs through June 30th. So last July, in the calendar year 2019, on July 1st, the town was in its fiscal year 2020. Okay, so using that as a starting point, maybe you can explain how the bills are issued and how the first two may be estimated, but the final two are actual, that kind of thing.
Absolutely. As you say, we're in a quarterly billing system. So the first two bills that are mailed beginning in July 1st, those are what we call estimated or preliminary bills. Those bills are, you'll notice one of the differences between an actual bill, which is what you just received, and the bill you would have received over the summer, is there's no valuation in those first two bills. They're preliminary. They're based on the prior year's taxes paid plus about 3%. And then split into two even payments. So once again, the first two payments, not unlike a gas company will often do. They'll base a bill based on the experience, how much gas has been used, come out, take a measurement, and then give a credit for that, and then issue a bill based on the actual use. Similarly, it's based on the prior year's taxes paid, split into two payments, and that's for the first two bills. Then comes the November-December timeframe in which I do my analysis that we just discussed for all the valuations. I submit that.
And the selectmen set the tax rate.
And the selectmen help establish, they set many of the parameters that goes on to the recap, and then which is sent in to the Department of Revenue, Bureau of Local Assessment, and they conduct an analysis or a review of my analysis on the sales, and also on different parts of the recap that relate to the accounting and the finance department, and ultimately certify the valuations and the tax rate.
Right.
So now we've got a valuation and a tax rate, and ultimately a bill where the first two bills that we just discussed are credited, leaving a balance which is split into the third and fourth quarter bills known as the actual bills. And you'll see the value, the certified tax rate on those bills, along with a lot of information, which I know you've outlined there, the book and page. There's a lot of information that by law has to be on a tax bill. So when reviewing this bill, I would remind residents to take a look at the valuation. If you have any issues with the valuation, you can either call my office, certainly, or file an application for abatement.
Yes, and following up on what Frank just said, if you take your third quarter real estate tax bill, which you've just received in the mail, and that is for fiscal 2020, as we said, do not make the mistake of going to the middle part of the bill where it lists your quarterly tax and multiplying that by 4.
Very misleading.
Because it will be, because if you do that, the answer you get is going to be higher than your actual tax. Remember that for the first 2 quarters, you probably paid a little bit less than you should have on a 4-quarter equalized basis, based on the methodology that Frank has just described. So let's talk a little bit about the taxes and the tax bill. And for the past 2 years in Chelmsford, we've had what is known, for lack of a better term, as a split tax rate. So maybe you could explain a little bit to the residents how that works.
I certainly will. Each and every, as part of the tax rate setting process, one of the things I have to do by law is go before the Board of Selectmen and present to them data as it relates to a number of different topics that they have to take a vote on. The topics that they vote on are whether to classify the split rate, which I'll get into, whether they have a residential exemption, a small commercial exemption, or a open space discount, and I'll spend some time on each of those. But the most relevant one, I think, is, at least for Chelmsford at the moment, is a split tax rate. So with the Board of Selectmen, what I present to the board is information relative to what the impact would be potentially of splitting the tax rate. By the time I appear before them, I've got my valuation certified, so I can pretty well give the information as to what the impact will be. And the scenarios that surround it, what it would be for each percentage up to 50%. So what ultimately happens is a splitting of the share, depending on what they vote on, would be to increase the commercial industrial by a certain percentage. Right now, Chelmsford has, say, an 80-20 split. 80% of our base is residential, 20 is commercial, roughly.
Based on value.
Based on value. So what that normally would translate to the same thing as making up that same percentage in the levy, the taxes paid. But the selectmen have the option of increasing the commercial, industrial, personal property to a number greater than that 20%, which they've elected to do each of the last 2 years. For fiscal 19, it was voted on to increase the commercial industrial by 27%. The effect of that is the commercial industrial pays 27% more than they otherwise would with a single rate, and the residential pay roughly 4 or 5% less than they would. That's what happened in fiscal 19 for the first time in a couple of decades. For fiscal 20, which just passed, they retained a split tax rate but dropped it from the 127 to 122. So the realized savings for the residential still, and still an increase for the commercial and industrial.
Actually, quite a bit, because, and again, just to recap a little bit, when the selectmen vote to split the tax rate, and we'll go back to 2 years ago when they elected to do a 27% shift, what that means, as Frank said, what that means is that the commercial and industrial property owners will pay 27% more of their property on property tax than they otherwise would have under a single rate.
That's correct. And what happened? So what I looked at for this year, even though they dropped it to the even though it was dropped to the 122, the average bill was $447,600. The average commercial industrial was roughly $1.3 million.
Valuation.
That's correct.
Right.
So when you compare that, when you consider that split, had there not been a split, it was $362 difference in the residential. So in other words, they're paying $362 less than they would with a single tax rate, in the commercial industrial, roughly $5,000 more.
And that's yeah, and that's actually very close to my situation. I have my property tax bills in front of me right now, so that we can have this discussion. And I noticed that the difference between what I would have paid this year, had we had a single tax rate,
Yep.
which we calculate would be somewhere around $17.26 a thousand. But because of the action the selectmen took, instead of $17.26 a thousand, the rate is $16.35. So the resident benefits. So I benefit this year. I will save $349 in my annual tax versus what I would have paid under a single rate. But the average commercial property will pay, what did you say, an extra?
About $5,100.
About $5,100 more. So the average commercial property pays $5,100 more, and I save $349. So it's kind of a lopsided situation. But you know, again, the selectmen, they get to decide under state law. They get to decide how to allocate the tax burden, and that's really what this is, because that action does not add any additional revenue to the town's coffers at all.
It does not.
It's just a way of dividing up
the same amount of money.
the same amount of money in terms of percentage and proportion. So, and I like to use my property when I talk about these things, because up until about 2 years ago, my real estate actually was just about the average for a single-family residence, so it was always pretty good. But now it's actually fallen a little below.
Well, I can do something about
So you can do something about it. You absolutely can. But just to assure taxpayers out there, even though I'm on the Board of Assessors, my value goes up every year, just like everybody else's.
Does mine. I'm a resident as well.
And certainly Frank, as a resident, makes sure that his value goes up every year too. So in 2019, my property had a total value of $416,000, and for 2020, that value has now risen to $430,300. So the overall, my overall assessed value has gone up 3.3%. The building went up 5.4. The land went up 1. So are those numbers fairly representative of what most people are going to see?
I would think so. The split between the building and the land is probably a fairly typical scenario. I think, and of course, you're in a single-family home.
Correct.
Condominiums were probably have appreciated. Not all complexes within the town, but many of the complexes have probably outpaced the single-family homes on a percentage basis.
And that's been the case for what, about 4 years now?
Yes.
We've seen the condos appreciate more rapidly.
That's correct. And we have quite a few condominiums here in town. We have 2,600 units. Compared to our single-family homes, we have about 9,000. So we quite a few condominiums here.
Now, relative to the style of the home, and obviously neighborhood as well, both of those affect value. But have you seen certain styles of homes in Chelmsford appreciate at a more rapid rate than others?
I have. Some of the splits and raised ranches seem to appreciate at a greater pace. Conventionals probably lag behind just a little bit. Conventionals are older style homes with the gable end basically facing the front. That essentially is what we call a conventional. Those are two things that I do recall. Commercial industrial probably lag behind all of them, just an easing up in the appreciation of the commercial industrial here in town.
Which is, I think, one reason the effort in the last 2 or 3 years in Chelmsford has been to try to get the commercial property values to increase by encouraging certain kinds of desirable development.
That's right.
Which ultimately, if that happens and we fill up empty spaces and so forth, will tend to increase the market value of those properties, thereby leading to a more stable situation with respect to how much the commercial property base contributes to the overall thing. So we've got a couple of minutes left, Frank, so would you take a minute and talk just a little bit about the appeal process and maybe some of the more common exemptions that might be available to taxpayers?
Certainly will. As I mentioned a few minutes ago, somebody's looking at the bill. It should be stated in the bill someplace that they can appeal. You can appeal your valuation. You can't appeal the tax rate. You certainly can't appeal the taxes, but the valuation, which obviously relate to the taxes. That would have to be filed with my office no later than February 3rd. I believe the forms are available online. If not, feel free to call my office. Anybody in the office can mail out a form. It just has to be back in my office by the 3rd of February. You can attach anything you want to the form. If you've had an appraisal done for a refinance for whatever reason, I wouldn't recommend getting an appraisal for this, but if you happen to have one handy, anything you want to attach and you feel best states your contention. Pictures of the home that you feel show some distress, whatever the issue is. And certainly feel free to call me if you want to discuss any of these issues. The other thing I want to really make known to people, we send it out in all the bills, are the personal or statutory exemptions the town offers. I'll review them very, very quickly.
You got 1 minute.
1 minute, okay. If you could get as much as $500 off if you're a single over 65 years old, $27,000 in gross income, assets not to exceed $40,000. Anyway, you call my office. We can send you all of these things in the mail, sent out in the mail each and every year. Feel free to give my office a call.
Very, very good. And also, if you appear at the office to take out a form to apply for abatement review and so on and so forth, the office staff is very accommodating. They're extremely knowledgeable, and they will actually help you to fill out the form and answer any questions that you may have. So the bottom line is the assessor's office is there to help the residents comply with the law. We don't want anybody to pay $1 more property tax than they are legally obligated to pay, and we will do everything in our power to assist you to make sure that you have an accurate situation with respect to your taxes. Thank you very much, Frank.
Thank you. I
Appreciate
appreciate it,
having
Sam.
you on the show.